Hi there, this is Joe from Bloom Accounting. Often I get asked, when should I incorporate? Or should I run my business as a sole proprietorship, or should I incorporate? In this video, I will explain the advantages and disadvantages of each in hopes that this information will help you in making your decision. First off, a proprietorship is one person operating a business without forming a corporation. Advantages of proprietorship includes simplicity. You don't have to formally incorporate an entity and be bound by the set of laws and compliance governing corporations. Also, low costs. Relatively low cost to set up, unlike incorporating, which is about $1,300 plus annual filing fees. If the business loses money, the losses can be written off against other income of the proprietor. The proprietor is in control of all decision-making and receives all the profits of the business. Disadvantages of the proprietorship. The biggest disadvantage of a proprietorship is unlimited liability. The proprietor is liable for all the debts and other liabilities of the business. If the business is sued, all the business and personal assets of the owner are at risk. Now, concerning taxes, if the business is profitable, it will usually be paying higher taxes than it would be if incorporated as a Canadian-controlled private corporation, also known as CCPC. And finally, concerning permanence. A proprietorship has a lack of permanence. If the owner dies, the net business assets pass to the heirs, but there's no permanence in a share structure that can be sold. Now on to corporations. A corporation is a separate legal entity, which is formed by application to either the federal government or provincial government. The corporation issues shares to the owner, also known as shareholders. Upon incorporation, it is prudent to ensure proper classes of shares are issued, which can facilitate future tax planning strategy and possible future investors. I will be doing a separate video about share structure and why this matters. One of the biggest advantages of incorporating a business is limited liability. This means that the liability of the shareholders is usually limited to the amount that they have invested in their shares in the corporation. However, many incorporated small businesses are not able to get bank loans without the personal guarantee of shareholders, so this eliminates part of that advantage of limited liability. The personal assets of the shareholders are protected from lawsuits against the corporation. However, shareholders who are also directors of the corporations can be held liable for some debts of the corporation, such as GST and payroll taxes in certain circumstances. Now, concerning tax rates, corporations generally pay less tax than individuals. A Canadian-controlled private corporation pays a much lower tax rate at the federal level and provincial levels on the first $500,000 of active business income. Bear in mind that active business income generally does not include investment income or rental income, which is taxed at regular corporate tax rates. And finally, one of the largest advantages is the lifetime capital gains exemption on qualified small business shares. Please refer to my separate video, which dives deeper into the details of QSBC shares and the tax exemption available. Now on to the disadvantages of incorporation. Cost and compliance. There's more administrative work for corporations. This includes annual reports filed with corporate registry, corporate tax returns which are filed separately from the owner's personal tax returns. Credit is also a factor. Establishing credit history may be difficult for new businesses. Banks request at least 2 years of solid financials before extending credit. They may also require financial statements at various levels of assurance. I hope you found this information helpful, and if you have further questions, feel free to contact me at Bloom Accounting.